Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are talking about. I'm going to interject my financial opinions across the board. It's going to be finance, wealth building, or commodity related for the most part. And if you guys need any help with anything, check out finding-value.com. I got a discount going on right now. You can use the word happy birthday in the coupon code and get yourself a discount on the first month, 50% off, if you'd like to try it. All right, guys, let's dive in here and see what's going on. And if you want to follow me, it's at finding_finance on Twitter. So this guy says, I want to talk about this a little bit. All right, he says whoever builds the Spirit Airlines of cars will become a billionaire. A vehicle that is simple, cheap, and safe. Roll up windows and shit. The market is craving this. Well, I mean that's the car I own, and I would say that people say it's a clown car. It's for the most part. The thing that's difficult is girls kind of dictate what guys drive to some extent, not fully, but to some extent. I bought that car when I was that was my first job, 2005, I think. I got my first job was in '04, but I got it when I was just kind of out of school, college, and it's just a cheap car. I bought it for $7,500, I think, and it was a cheap car, just like this guy's describing. What I noticed, and whatever it is, girls like guys that expend more energy. So they like guys, and they view wealth as energy consumption to some extent. So let me walk through real quick what I mean here. So a girl prefers a guy who has his own car versus riding the bus. So they'll for surely take the guy who, or prefer to have the guy who owns an individual car and can drive them around in an individual car versus the bus. Then you step it up. They prefer guys that have bigger cars or more expensive cars. Like they would rather prefer to be driving in a Escalade or a Suburban than they would driving a small smart car or a small economy car like a Ford Fiesta or whatever it is. Then you can go further than that. They would much prefer to drive in a limousine versus a Suburban. So they would be like, wow, this guy's got a limo and he drives around a limo with a driver driving him. That's way better than having a guy that drives a Suburban. Then you go even further. If the guy has a helicopter and he helicopters in to his house, burning far more fuel than any of those other options, well, they would definitely prefer that because a helicopter means you've got even more money. Then you can go even a step further. If you have your own private jet and you're jetting around the world, uh, and you are burning copious amounts of hydrocarbon, well, then they prefer that because they get to go fly in a jet, their own private jet, even though it may cost, $10,000, $20,000, $30,000 per fill up to fill up a gigantic private jet. I'm talking about the big ones. So as you can see, this very well may be the case. They may make money off of something that's very affordable. And don't get me wrong, guys, I would love to have a little sports car with roll up and down windows with a complete low weight cost, almost like a Lotus Elise or something. That'd be cool. At a cheap price point with a nice little like inline six engine or something like that. But overall, guys, the girls they crave fossil fuel burners. It's just the way it is. Let me know what you guys' opinions are of what I just said there in the comment section. What do you guys think? I'd like to know your opinions. But that's my experience. It says the number of people unable to understand that a stock and a company are not one and the same is astounding. It says Nvidia is untouchable in some of their markets. Data centers and AI ain't going anywhere soon. Sky is the limit. The reason I posted this or shared this is that is what market limit or that's what market tops look like. People start spewing this stuff everywhere. Nvidia is untouchable. Data centers and AI ain't going anywhere. Sky's the limit. That is what a market top looks like. Do not touch that stock, in my opinion, or at least I'm not going to touch that stock. Um, don't not advice or anything like that. I'm not going to touch Nvidia because people are starting to come out and say this type of stuff. Nvidia is very expensive. Expensive doesn't mean it's going to go down, but it's definitely not a value stock. It's definitely a high growth stock, and hopefully that growth materializes. That's where the problems generally come from. Here's the economic long wave. It says a sovereign debt crisis is inevitable, then rates will skyrocket. When the government borrows hundreds of billions of dollars to fund a spending orgy, it competes with commercial and consumer borrowers for the same cash, thereby driving up interest rates. I would say that high rates of inflation is what drives up interest rates. And the reason is because people don't want to hold bonds in an inflationary environment. Then, if money keeps getting gushed into the system, people will start to question the legitimacy of bonds and their returns. And if they start questioning the legitimacy of their bonds and returns, because if you've got high inflation and you've got a low interest rate or a lower interest rate, which is a real negative return, nobody wants to own the bonds then. Then they come out, they do QE to hold bond, the interest rates down so that the government doesn't bankrupt themselves. And I mean that's kind of where we're at. And that could be, Canada, it could be America, it could be UK, it doesn't even matter. It's all over the place. This could also fuel the largest bull market in gold and silver. And the reason is because if nobody wants to own bonds, they have to put their money somewhere else. Where do they go? That's the great rotation of money that I talk about. And it's not immediate. It can be immediate, but I don't think it's immediate, which means it starts to move, at a little bit at a time, and then the speed kicks up over time, and then the speed will kick up a lot over the time. And eventually, if the entire world starts to do this, you have a lot of people running at a very small asset with a lot of money. The bond markets are gigantic in comparison to all these other markets. And that is the fuel for potential returns, the fuel for driving whatever asset classes it's going to rotate into. And that's the fuel for it to go much, much higher. Coming on down, interest payments on U.S. government debt are getting interesting. So this is the annual interest payment on U.S. government debt. Just shot up by about 80% from March 2020. Guys, this is going vertical. Now, we were kind of slow in the 60s. You can see it's flat. We kicked up in the 70s. We went back sideways a little bit, almost consolidated upward in the, we'll say, 2000s and mid 2010s and all that. 2020 onward, it has been vertical. And I don't know how sustainable this really is. I mean, if you've got something that goes straight up like that's going to cause problems. It's going to be highly inflationary potentially too, depending on where that money goes. It could be inflationary for financial assets. It could be inflationary for wherever the money goes. And that to me looks like a problem. Whenever you go vertical, you've got a problem. You know what they say? Never go full retard. I don't know where that came from, but table napkin valuations are better than multi-page Excel valuations. I agree with that. And I know a lot of people are like, well, what's the company's return on equity? What's this? What's that? They want to dive in and know all that information for a commodity stock. The problem is those that information is highly dependent on what the commodity price is and what volumes the company can move at certain prices. So a company that is a high cost producer isn't going to make anything when the price goes below their break even point. And you can do all the evaluation you can on all of these different stocks, but really, I think the framework that at least that I operate in is it's kind of like, okay, where are the break even for these guys? roughly in this general location. All right, do I think the price is going to go way above that? If the answer is yes, then it's just one big leveraged play because the high cost producers are the ones where their earnings per share fluctuate the most when the commodity price goes up. They go from not making money to making a lot of money. And if the price stays up for a very long period of time, they can scale their production as well, which generally decreases the break even cost to some extent. Sometimes, not all the time. Think of it as economies of scale. But going in and doing these multi-page Excel valuation things, they really don't pan out the majority of the time. You're just wasting your time. So I agree with Fur completely. Table napkin valuations. You want to just get in the ballpark and then you have to say what matters and what doesn't matter, and then you make a bet. If the commodity is what matters, you're making a bet that the commodity price will go up and turn these guys on. I'm just using that as one example. It says it doesn't matter how much money is thrown at finding and producing more oil. The fact remains we are now using 5 barrels of oil for each 1 barrel we find. It doesn't take a brain surgeon to figure out we have now reached the energy cliff. So what he has here is what he's looking at is what are we finding in relationship to what are we using? And this is for global oil discoveries versus net global oil production. Net global oil production is the dark colored, gold color kind of. Global oil discoveries is your silver color. So if you look at the 70s, we had a large discovery in relationship to what we were using. We were plus 248 billion barrels. And then if you look to the right, you can see that we were running more and more deficits. -6, -31, -147, -215, -240. So here we are using 5 barrels of oil to every one that we find. As this continues, we are going to run and hit a peak in oil. And a lot of people say, "Oh, it's a good thing. We'll produce less emissions." The people on Earth are here because that oil has been produced and because the oil has returned so much energy to society. You must maintain and grow that energy return. If you don't grow or maintain that energy return and grow it in ever growing quantities, your GDP, which is tied to energy consumption, will decline. I don't know if we can do that with renewables only. And in fact, I don't think we can. Uh, Renewables are subsidized by fossil fuel and the returns of fossil fuel all over the place. We could maybe offset a lot of this with nuclear. Nuclear could very well be an option, and we are going to, in my opinion, as a human species, implement more nuclear. We have to, period. It's not even a debate. Oh, yeah, we'll just throw more solar panels. Really? With a 10% utilization rate or something on the lines of that? Unreliable energy baseload power? I doubt it. I just doubt it. Another one, it says, tell that to the Indians who just reported record fuel consumption in May of 2023. While Western economies might be slowing in the months ahead, lots of places around the world eating up weaker oil demand from OECD countries. India's May fuel consumption soars on robust manufacturing. India has a very strong population growth. That is generally what drives a lot of this consumption. And they're also in the middle of their S curve. So, yeah, I think India is going to have a very strong oil demand for a very long time as they pull themselves into greater and greater prosperity. It appears that Tiff Macklem, Bank of Canada, watches Finding Finance. What he is saying kind of sounds familiar. I want to read this, guys, because it is almost exactly what I say. He says, we don't target housing prices. We don't target the housing market. The housing market is an important part of the economy, but there's a lot of other parts of the economy, and we really have to look at the whole thing. The fundamental issue in the housing market, and this has been an issue in Canada for 10 years at least, is structurally the demand for housing is growing faster than the supply. And so, yes, interest rates go up, the housing market will slow, but it's only going to slow so much because there's a sort of structural shortage of supply relative to demand. I think what you're seeing is that with the supply growing less than demand, the housing market has started to tick back up. Housing prices have started to tick back up. That's something we need to take into account in monetary policy. But we're not targeting the housing market. We have one target, CPI inflation. Yeah, I agree with what he said. Totally. Zillow's home price is at an all-time high. So we've got economists at Zillow expect U.S. home prices, as measured by the Zillow Home Value Index, to rise 6.3% between June 2023 and June 2024. People are expecting home prices to go up next year, at least Zillow does. It says, what does the energy cliff look like? High prices and shortages, followed by lower prices and surpluses. Currently, nat gas in Europe is in the lower prices and surpluses stage. This will likely switch back by the end of 23 or into 24. Massive nat gas injections July 13th. Europe's nat gas inventories are now heading above the ultra bullish 2020 pandemic shutdown trend. No coincidence that Dutch TTF now trading at 857, down from 1332 just a month ago. The one thing to talk about here is when your capacity gets eaten up, prices are going to become ultra sensitive to swings in production, demand, or I should say supply and demand. They're going to be ultra sensitive. So we're going to see large volatility in nat gas, I think, for a good while to come. Very low prices and very high prices. It's going to be a trader's dream as weather fluctuates these things back and forth. So as Mike Maloney says, and I agree, it is impossible for BRICS to create a gold-backed currency at these gold prices. There is way too much currency in the world and not enough gold. It's not a solution to double or triple or quadruple the quantity of gold. The only solution is to double, triple, or quadruple the price of gold. So I agree. I think we could see a large revaluation of gold to the upside. And gold is tied to all the pricing of commodities. That's why we do all those ratios of gold to oil, gold to silver, gold to platinum, gold to whatever it is. And if we see a revaluation in gold, I think that's just going to be a large revaluation of commodities in general. Here is URA. It actually looks good both on the nominal scale and log scale. The path of least resistance is the big leg 3 up. And here we are starting to break to the upside for URA in uranium and also for URNM. So that's Global X uranium there. This one, yeah, both ETF RSI. So that looks really good for URA. And hopefully this is the leg, wave 3 up that we've all been waiting for. But that's what I've got for today, guys. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. I've got a couple of guys coming on. I've got Patrick Karam coming on. And also Uselink will be coming on at some point here. Hopefully this weekend. And we can get their opinions. I think a lot of breakouts or important information is here this past week or was created this past week or two. So I'd like to talk to them about what they're seeing in the charts, what changes they've seen, if we have any important breakouts, stuff like that. So, all right, guys, we'll catch you guys later. This is Finding Value.